Well, welcome to episode 15 of ScottCast, the podcast. This is 15. Hard to believe it's been this many, but I thought we would talk about some of the most common questions that are coming in from listeners of the podcast and also into the financial planning practice over in College Park. And obviously the market's been all over the place. The news is right along there with it. Seems like open up a news page or a newspaper and there's a new headline with something new to worry about.
Yeah, you don't even have to wait for the newspaper, right? It's pretty much constant stream of lovely information rolling in at you at every turn. So yeah, I mean, it's interesting times. I can't remember who said it, Mark Twain or somebody. I feel like every quote pretty much is Mark Twain. But may you live in interesting times. So congratulations, everybody. We're living in interesting times. It's the news is obviously enamored with the story, and
sure,
somewhat rightfully so. It's a health concern, and whenever the health of your loved ones, your neighbors, your family, your friends is in question,
right,
we all get a little nervous.
Yeah.
I'd be lying if it wasn't troubling to me as well. With that said, the 24-hour news feed and the constant reminder of it, especially now that many of us are confined to small spaces for long periods of time with the only companionship being the television, it's a little much, and it's not healthy in any way, shape, or form, and it certainly isn't conducive to thoughtful financial and or economic decisions.
Right. So I thought we'd unpack some of the most common questions we're getting inside the financial planning practice. And I would say one of the big ones is, should I do anything? What should I be doing? I feel like I should do something with my money to be proactive. Should I do anything?
That's a tricky question because everybody's different, of course. But the answer is probably not.
Yeah.
If I can broad brush this and then maybe narrow down a little bit. So the
Sure.
people that are growing money, people your age, even people my age in their mid to late 50s, I would say doing nothing probably makes the most sense. And, in my 32 years of doing this, that's a statement that really annoys clients sometimes.
Yeah.
Because they're like, well, do nothing. Why are we paying you to do nothing?
Yeah.
Well, that's actually why you are paying me, so I can keep you from doing something silly right now. I've been, like I said, in the business a long time. And in the 7 or 8 end of the world scenarios I've been through, we are 8 for 8 in recovery, right?
Yeah.
So, clients say, well, what are the possibilities? I say, well, there's 2 possibilities, right? The first possibility is that the one that's been the case each and every time, which is this is tough, this is uncomfortable, this is nerve-wracking, but we're going to get through it. And eventually markets will recover and move to new highs like they have every single time. And I know you have some statistics on recoveries and how quickly they take place. Option 2 is the apocalypse, right? It's the zombies and all that kind of good stuff. Road Warrior, whatever your analogy or metaphor or movie of choice is. That's the second option. That is to say that it's fighting over apples in the street, corn seed and gunpowder, as I'm fond of saying, where money has no value and the currency is brute force, right?
Yeah.
I don't know how to invest for the latter, right? There is no investment that I can buy that short of maybe hoarding and building a bunker underground, which, those people are probably having their day right now, very excited. But short of that, there is no preparation for that. There's no preparation for the dollar doesn't have value. There's no preparation for the banks are out of business.
Right.
That doesn't exist. So we're going to go ahead and prepare for the one that is more likely, which is this is going to suck for a little while, but eventually it's going to get better.
Yeah, I've been telling people we know the narrative. We know how 2000, 2001, 2002 panned out. We know how 2008 and 2009 panned out, and we know the narrative. It's just very hard to grasp that story and what the future is going to hold, but I'm confident that we'll see the same type of uplift that we saw coming out of early 2000s and then again in 2008, 2009. So again, I think conceptually we know the story, we know the narrative, we know what's going to happen, but it's still difficult because there's such an unclarity over the next 6 to 9 months? Like, what is going to happen?
Yeah, we don't know. We don't know what's going to happen.
Right.
Depending on what documentation you read or what, in our case, what webinars we've seen, 5 or 6 of them every day from every investment company on Wall Street, the consensus seems to fall somewhere in this is a 3 to 4 week problem or a 10 to 12 week problem. Meaning that peak cases, meaning more people get better than get sick, has occurred in China at this rate, South Korea that rate, in Italy and other rates. If we average that out, we expect the good news to be today more people got better than got sick, right? And when that occurs, first of all, it'll be too late. So those of you who are waiting around saying, I'm going to invest when the numbers turn, that's too late.
Right.
The market will be way ahead of you. So trying to get in then is a mistake, which leads us to, well, what should I be doing now if I'm a growth person versus an income person? Mm-hmm. So if you're a growth person, again, somebody your age, and again, even my age, if you have 2, 3, 7, 10, 15, 20 years, especially of growth ahead of you, this is counterintuitive, and everybody says they'll do it. But you should be a buyer right now. If you have some liquidity, which I know is hard to come by for some people right now, buying down on the positions you own would make a lot of sense. And you and I were joking before we started rolling that people will say, well, what should I do? And we say, well, you should be a buyer right now. And they go, no. What should I do besides that?
Right. Yeah.
I don't want that answer. Give me a different answer. But it's still the same answer. People in 2000 and 2001 and 2008 who were net buyers at that time came out way better than everybody else. We have a market that was close to 30,000. We have a market that's close to 20,000. That's a 30% discount to where it was. You say, well, it was overpriced. Okay, maybe a little, but it wasn't 30% overpriced. Right. And now you're buying stocks like Apple, and this is not for the lawyers and compliance people out there that we're constantly having to worry about. This is not urging you to buy any particular stock, but stocks like Microsoft and Apple, which people like typically.
Sure.
They loved them 30% ago. Now suddenly we don't like them. Yeah. So again, obviously that doesn't make a whole lot of sense. For people who take income, you should always, and I've said this on previous podcasts, and it's something we do in our practice together, is that we're pretty adamant about keeping at least a year, if not 2 years worth of cash on hand. And the reason is not anything sexier than a time like this.
Right.
As I said to a client this morning, I knew this was coming. Not this. I didn't know what the this was, but I knew this was coming.
Yeah.
And now this client that I talked to who's upset and worried realized that they don't have to sell a single share of anything for 2 years because we have the cash on hand to get them through that period. And there is no downturn in the recent memory where 2 years wasn't enough time for shares to come back up to value.
Yeah. So chances are I've been saying if you were positioned correctly before all this, chances are you're positioned correctly after, and you don't really need to do anything.
Right.
However, for somebody that maybe hasn't produced 2 years worth of cash and is starting income, maybe now's the time to look at that and say, oh, well, I should have had this all along. Or the other big thing is a lot of times during downturns, the mistakes are magnified.
Yes.
If you were taking too much risk before, well, now you got hammered. So that's the only time we've been recommending changes is if, well, maybe you weren't positioned correctly before. And again, that happens mainly with prospective clients and a lot of referrals that have been coming into the office as of late. So for the vast majority of people, no, you probably shouldn't do anything during this period. But if you haven't looked at things in a while, maybe it's time to take a close look at it.
Well, it's and I would resist making any changes, even for that person that has not been thoughtful in their planning prior to this moment. Now is not the time to make a change.
Yeah.
When markets come back, and they will come back, that would be the time to think that. It's like, when somebody dies, right? We always tell people if you lose a loved one or a spouse, don't make any big decisions, financial or otherwise, for a few months because you're not thinking clearly. You think I've got this, I'm in control, but you're not. You and I have seen it hundreds of times with widows or widowers where they come in a few weeks after the event and I'm good, and then we see them 6 months later and they go, I really don't remember any of it. Yeah. Right? This is somewhat shocking. So I would advise against that. But to your point, I'm fond of saying that the amount of risk you have to take is really a byproduct of how responsible and practical you've been in your planning. And if you've been kind of a roll the dice kind of person, well, you just rolled snake eyes. You shouldn't have gone into it with that. We should always. I'm fond of telling clients that I'm not worried about what is happening or did happen. I'm worrying about what could happen at all times, even if it doesn't. So you should always, especially as a retiree and you're taking income, you should always expect an event like this every 3 to 5 years. And they come like clockwork.
Right.
They really do. 9/11, 2008, the tech wreck, the Asian contagion, and I could go on and on and on and on. I mean, heck, even epidemics. How many of those have we had in the last? I know you had.
It's like 12 to 15. It's crazy. I mean, Ebola, we had Zika, H1N1, which was swine flu. I mean, the list goes on and on.
Yeah.
There's an endless story of bad news that affects the markets.
And you should always be aware of that in your planning. If you're a growth person, you don't need to worry about it as much because those epidemics and or catastrophes represent just buying opportunities. Again, if you believe that the United States of America and market, I say free market capitalism, whatever it is we're practicing now, capitalism is to go on. And I get that there are people that disagree with that, and that's totally cool. But if we assume something that looks like this is going to continue, then you have to continue in that mindset.
Sure. So that was answering the question, should I do anything? Let's transition to go into the next big question that's been coming into the financial planning practice, and that is, should I stop contributing to a retirement account? And the root of the question is, should I stop contributing to a 401k, 403b, my investments in general? The news says it's really bad. It seems like I'm throwing good money after bad. I've heard that several times. It seems logical to want to stop the contribution going in and wait for things to get better. But we both know that is not a good idea.
It's catastrophic. The people who stop contributing, or worse, remove assets from growth vehicles.
Yeah.
You and I know from our throughout history of our practice, those people fall behind the most.
Sure.
Because here's the problem. You and I discussed this, I know, in another podcast, is you have to know when to get out, and you have to know when to get back in, right? And you're likely not going to get either one of those right. And what happens to people is, market craters like it has, well, nobody could get out of the way of this. This is a truck rolling downhill. Nobody was able to move. And now you're saying, well, I'm going to get out now after the market's down 30%, and something will occur. I'll read something in the newspaper, see it on TV, or the stars will align. Something in my horoscope will tell me it's time to get back in. But what will actually happen to 99% of those people is they will watch it come back up, and they'll watch it come back up 5% and go, I'm not buying it. And then they'll watch it come up 10%. No, it's going to turn back around. There's no way this holds. And they'll do that 4 or 5 times over the course of 2 or 3 years. And then the market will be up 35%, actually beyond where it started when they started to panic. And then they'll go, I'm ready. And then they will repeat the process. Then 3 or 5 years will come back. They will have earned 0 because they got in after the run, and they will sell again. And every single person listening to this podcast is saying, I wouldn't do that.
Right.
I wouldn't. Vinny's saying, I wouldn't do that. Right? Yes, you will. And yes, you have. I've watched it happen hundreds of times. So it is absolutely catastrophic. I joke all the time about 401ks. And I say, I'm in a meeting and there's 100 people. You've witnessed this. I've been in a meeting and there's 100 people in the room, and there's always some angry man sitting up front with his arms folded like this, and he hates my guts, which is hard to believe. And he comes up to me and, you don't understand the markets. You haven't told me what to do, and yada, yada, and just like all crystal ball kind of stuff he was expecting or hoping for, and he didn't get it. And he's always the guy with not nearly enough saved. Meanwhile, there's a little old lady knitting a sweater who hasn't looked at me once, could care less about my great jokes that I'm trying to tell. She's got $1 million in the 401k, not because she's traded in and out and this, that. She hasn't moved anything in 20 years.
Right.
She doesn't care. She's the one with the $1 million because she hasn't knee-jerked in and out. So I cannot say this enough. I don't think we're allowed to call people stupid, but that would be a stupid decision.
To stop contributing to your 401k. The other big thing is that the money's going in at the current market levels.
Yes.
It's not like it goes in at last month's price or how the year started or anything like that. If it's a 401k, every single paycheck goes in at the current market level, which unfortunately is down. So it's going in at those lower levels. Same thing on IRAs, same thing on really any investment account that you're contributing to. You buy at the current market value. So I think that's another concept that people don't always grasp, that, all right, my money's going in. Yes, the market's dropped. Yes, shares are cheaper. Things are on sale now. My money's going in at those levels. I think some people miss that aspect of it as well. And again, so they justify, oh, I don't want to throw good money after bad by putting it into that 401k that's not working.
Yeah, the 401k is fundamentally broken now, right? It was all the shares on average were $10 and now they're $5. Why would I do that, right? And it's the most amazing, mind-bending experience to listen to when somebody says, well, I'll make up XYZ mutual fund when it was $17. Well, I don't know how I feel about it now at 13.
Right.
Well, shouldn't you like it even more? Because it owns the same stuff it owned at 17. They're just depressed. So, yes, that is throwing good money after bad is one of the most annoying phrases I've ever heard in that instance, because I don't know how to get through to those people, the poor decision they're making. Having said that, a lot of people now get that. I think 08's what I'm experiencing in talking to people right now is 08 is close enough in the rearview mirror, hopefully, that they realize the mistakes they made then, and they're trying not to repeat them. Even as recent as December of 2018, as I know you recall, I think the market on it, the S&P 500 was down almost 20%. And we had very few people try to jump out of the boat. We had a couple, and those people are still not back in the boat. Now, they're laughing right now because we're pretty much at the same spot, to be fair. But again, I think these are lessons people are starting to learn. But if you're a new investor, you're a 401k investor, and you just really haven't paid a lot of attention, and you look at your statement this coming month, it's going to be awful.
Right.
You need to be prepared for that.
Yeah. So stopping your contributions during a period like this can be detrimental. So don't do that. Again, that was a big question that came into the financial planning practice. Should I stop contributing to a 401k, 403b, my IRA, my investments? And the answer is no. Keep it coming in because, again, it's going in at these current market levels. Next question that we've been getting is, what are my best chances of recovery? The market's down. I've logged in online. I see that my account value has lost money. What can I do, or what steps can I take to make this thing go up quicker than it dropped? Is there some sort of secret? Is there something you can do to help the recovery come faster and get us through this?
That's a great question. Yeah, I mean, is there something you can do? First of all, it's largely a byproduct of how quickly the markets themselves recover, right?
Sure.
If the S&P 500 goes hyperbolic and straight back up to 28, 29,000, well, you didn't do that. The market just did that.
Right.
You can't control that. Neither can I, neither can anyone else. I suspect something that looks like that, if not exactly that, will probably transpire. That at least seems to be the conventional wisdom on Wall Street right now. What could you do? I mean, you could average down, again, if you're a growth person.
Sure.
And maybe this is getting a little too far into the weeds, but you owned a 60-40 portfolio. 60% of your money was in stocks, 40% of your money was in bonds. Two things to understand here is that 40% that was in bonds has kind of held you up. Mm-hmm. You're not down in most cases as much as just owning stocks, right?
Right.
Now, there's a problem there. The problem is that when this thing does turn, and if it does go hyperbolic, fixed income, bonds, and things like that, debt instruments, are going to struggle. There's zero doubt about that. So one way, in my opinion, that something you could consider looking at, not for everybody, Mr. Compliance Guy, is something you could look at is, should I lower my fixed income positions because those are pricey because they're up?
Sure.
And diversify or rebalance, which is a commonly accepted practice, into stocks that are now down, right? So you've got bonds that are up, stocks that are down. Maybe I should sell some of this to buy some of this. Every situation's different. I'm not saying everybody should do this. I'm just saying it's something to think about.
Yeah. And I agree. So that's rebalancing. Another thing you could look at, now this is not necessarily recovering faster, but Roth conversions are a little bit better than they were a couple months ago. When you convert to Roth, you take the current market value and you convert to Roth, which means you pay taxes on it. So again, right along with rebalancing, not right for everybody. Depends on your situation in life, your tax status, age, bunch of different metrics. However, that makes a little bit more sense than it did a couple months ago.
Yeah, I mean, it's good news, bad news, right?
Sure.
The bad news is your IRA's down. The good news is if you converted it to Roth, you'd pay less taxes today than you likely would have 4 weeks ago.
Sure.
With the idea that conversion, yes, you would pay the income tax, but that it would, in my hyperbolic situation, you would make that gain back while having paid taxes at the lower account value.
Yeah. I mean, definitely a little bit more, I would say, advanced and a little bit
Yeah.
more specific strategies, rebalancing, and then also Roth conversions. Again, not right for every single client, but if you want to have a conversation with one of our financial advisors in our financial planning practice, you can shoot me an email. I'm michael@raymondjames.com, or you can always shoot Scott an email at scott.brown@raymondjames.com. So these were the biggest questions or the top questions we're getting in the financial planning practice. Should I stop contributing during this period? What should I be doing? And what are the best chances to get out of this thing? So again, this was episode 15 of ScottCast, the podcast. If you have an idea for a future podcast, we'd love to hear it.
Tell me now, like you told me back then, that we'll be together till the end.